Washington allowed Lehman Brothers to collapse, then less than 48 hours later committed billions of dollars to prevent an insurance company called AIG from sharing the same fate. That contradiction is the mystery at the center of this story. Why was Lehman left to die, while AIG became the company Washington decided it could not lose? The answer was not that AIG deserved protection, or that officials suddenly stopped caring about the dangers of bailouts. It was that Lehman appeared to be one collapsing institution, while AIG had quietly become a guarantee holding hundreds of institutions together. By the time officials understood the difference, AIG's rescue would begin with an emergency loan of $85 billion and eventually expand into more than $182 billion in available federal assistance. But to understand why Washington crossed the line it had drawn only hours earlier, we first need to see what AIG had become. Most Americans knew AIG as an insurance company protecting homes, cars, businesses, and millions of policyholders around the world. But hidden behind that familiar business was a smaller, far more dangerous division called AIG Financial Products. It sold credit default swaps, contracts promising to compensate banks and investors if certain bonds or financial securities suffered losses. Put simply, Wall Street bought protection from AIG and then used that protection as proof that its own investments were safer. For a while, the arrangement worked. Housing prices remained strong, mortgage losses stayed limited, and AIG collected fees without paying enormous claims. But much of this business operated outside the capital rules and safeguards applied to traditional insurance. Eventually, AIG Financial Products had written tens of billions of dollars in protection on complex securities containing subprime mortgages. Wall Street believed it had spread that housing risk across the financial system. In reality, much of it had been quietly concentrated inside one enormous corporate group. When housing prices fell, mortgage defaults increased, and the securities protected by AIG began losing value. Then came the part almost nobody outside the contracts could see. If AIG's credit rating fell, its counterparties could immediately demand billions of dollars in additional collateral. A problem that might have unfolded over years could now drain AIG's cash in days. AIG still owned valuable insurance companies and other assets, but it could not sell them fast enough to meet demands arriving almost immediately. The company was not necessarily worthless, it was simply running out of accessible cash, while the entire financial system was running out of patience. During the weekend of September 13th and 14th, 2008, officials were already struggling to find a private buyer for Lehman Brothers. At the same time, AIG's executives were racing to raise private capital and convince markets that their company could survive. When Lehman filed for bankruptcy on September 15th, confidence did not merely weaken, it vanished from the markets AIG needed for emergency funding. Then the rating agencies downgraded AIG. Those downgrades activated contract clauses that triggered approximately $13 billion in additional collateral demands. The downgrade did not create AIG's vulnerability, it pulled the hidden mechanism into motion. Banks that had treated AIG's promises as reliable protection now had to ask a terrifyingly simple question: would those promises survive another day? If AIG defaulted, its counterparties could lose their hedges, record new losses, and search for replacement protection in a market already collapsing. And the danger did not stop with investment banks. Money market funds held large quantities of AIG's short-term commercial paper, so losses could intensify withdrawals from funds that businesses and households treated almost like cash. AIG also operated across numerous countries, legal systems, and regulated insurance subsidiaries, making an uncontrolled bankruptcy extraordinarily difficult to contain. By Tuesday, the question was no longer whether AIG had made catastrophic mistakes, but whether Washington could allow those mistakes to strike every institution relying on AIG at the same moment. Officials again pushed the private sector to produce a rescue, but banks facing their own losses would not provide enough money, and AIG's private funding effort failed. Now came the contradiction Washington could no longer avoid. Only one day earlier, it had refused this kind of intervention for Lehman. On September 16th, the Federal Reserve authorized the New York Fed to lend AIG as much as $85 billion through a secured emergency credit facility. AIG pledged extensive assets as collateral, while the federal government received the right to a 79.9% equity interest. This was not a reward for management, or a declaration that shareholders deserved protection. It was an emergency attempt to keep AIG paying its obligations, while its businesses could be restructured and sold more orderly. The rescue was later revised and expanded until the government had made more than $182 billion in federal assistance available through loans, investments, and specialized facilities. Supporters argued that the intervention prevented a chain of destructive losses, while critics challenged its terms, its counterparty payments, and the precedent it created. The Lehman comparison remained impossible to escape. Washington had demanded consequences from one company, then protected another when those consequences threatened to spread everywhere. AIG survived not because it was innocent, but because its guarantees had become embedded so deeply inside global finance that its failure could no longer remain its own. Washington feared that rescuing another corporation would confirm that some institutions had become too big to fail. What officials discovered instead was even more disturbing. AIG had become too connected to fail, and the price of discovering that fact was a rescue ultimately authorized at more than $182 billion.